Hi, my name is Christian Waldegrave and this is Teekay's conventional tanker market update for September 2013. Now the theme of the last few weeks has really been some disruptions to oil supply in different parts of the world, and that's had an impact on the tanker market in a number of ways. Probably where we've seen the biggest disruption has been out of Libya. Now if you remember 2 years ago, Libya had a civil war and their oil production dropped to almost nothing. It came back quite well in 2012 and had got back to about 1.4, 1.5 million barrels per day of production. However, in the last few weeks, we've seen a number of strikes at port facilities and also at the oil fields, which have meant that oil production has gone back down to maybe just 0.1, 0.2 million barrels per day. And those disruptions have come upon other disruptions in other parts of the world, which have accumulated. If you think about Iran is already pumping about 1 million barrels per day less than what they were prior to the sanctions. We've also seen some disruption from Iraq, where there's been repeated bombings on the Kirkuk to Ceyhan pipeline. We've also seen smaller outages in Syria, Yemen, in Sudan, all due to geopolitical issues. And we've also seen lower output from the North Sea due to some unplanned maintenance there and the normal seasonal maintenance that goes on in the summer. So when you add up all of these individual disruptions, it's about 2.5 to 3 million barrels per day of oil production that's been taken off the market. Now, as I said, that impacts the tanker market in a couple of different ways. First of all, in the Mediterranean in particular, it means there are fewer cargoes available to be transported, and that's had an impact on the Aframax and Suezmax markets. Secondly, it's pushed the price of oil upwards. So Brent, which had been around $100 per barrel for several months, has in recent weeks gone up to about $115 to $120 per barrel. And so a high oil price does a couple of things. One, it crimps on demand. It means that global demand is a little bit lower. And secondly, it also adds to the cost of bunkers, which is a cost that ship owners then bear. And the other effect that this has had is that the price of light sweet crude has gone up more relative to other grades of oil, particularly Brent. And what this means is that Brent is trading at a premium to other types of oil, particularly WTI in the States, but also Dubai crude. And when WTI trades at a big premium to Dubai crude, it means that Asian buyers prefer to take oil from the Middle East versus West Africa and other places in the Atlantic. So that has a detrimental effect on ton miles, because if the Asian consumers are taking oil from the Middle East and not from the Atlantic, it's shorter distance and therefore you need fewer ships to satisfy that demand. And added on top of that, we're now about to go into autumn refinery maintenance as well. And so there will be less demand for crude on a global basis there. So the tanker rates, when we look at them, they're down into the low teens again, around $10,000 per day or $12,000 per day across all the segments, VLCC, Suezmax and Aframax. We expect that these low rates will persist through the rest of Q3 and into Q4. However, towards the end of the year, we would expect that the normal winter pattern of tanker demand would emerge, especially as we get into December. That seems to be the month now where we get these rate spikes, especially in the northern hemisphere and in the Atlantic. And I think this year will be no exception. I think we'll see a weak market through October, November. Then in December, we'll start to get the weather disruptions, the shorter daylight hours, and the increase in demand for heating oil. And that should add to a better tanker market over the winter. So that's our update on the conventional tanker market for September 2013, and we'll speak to you again next month.